It was 6 or 8 short months ago, when the acronym TINA, there is no alternative. There is no alternative to investing in the American economy, investing in American capital markets. There is no alternative in American housing, in many American institutions. That was the rally cry. You heard that from economists all over the place. How quickly that has changed. There's a hesitancy for foreign direct investment in the US.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, current events through a real estate lens. Thank you for joining me today. My guest today is Chris Nebenzahl, who is housing economist at John Burns Research and Consulting. His focus is on single family homes or on the residential industry, both for sale and for rent. BTRs, build to rent, single family SFRs are acronyms that he uses, and also the apartment multifamily industry. Chris has access to incredible data sources, and we talk about interest rates, about immigration policy, how that might impact both housing on the demand and on the supply side. And we look at some of the macroeconomic factors that are affecting the market at the moment, including the perception of investors of American exceptionalism and the impact that that has on treasury rates and by extension on interest rates and the pressure in turn that that puts on the Fed. Lots to discuss, or lots that we discussed today. I'm sure you're going to find it extremely interesting, definitely well worth your time. I listen to a lot of podcasts, and I actually find my own amongst the most interesting. And that's nothing to do with me. That's mostly to do with the incredible insights of my guests, and Chris today is no exception. If you have not yet subscribed to my newsletter, please go ahead and do that, gowercrowd.com. I do write detailed summaries of these conversations, and will do, about my conversation with Chris today in there, so you can access more detail via email and in written form if you prefer. And I also share insights into how to raise capital actually during these uncertain times, also through the newsletter, and some AI hacks and various other cool stuff once in a while. So anyway, all there at gowercrowd.com. All right, let's move on to my guest, Chris Nebenzahl, housing economist at John Burns Research and Consulting, coming right up. Chris, fabulous to meet you. Thanks so much for joining me today. All right, why don't we just start at the very top, as I said we would, and just tell me what you do there at JBREC, John Burns Research and Consulting. Just give us a high-level overview of what you do, and then I'm going to start getting into some of the details.
Sure thing, Adam, and thanks for having me on. I'm excited to talk with you today. So I oversee our rental research at John Burns Research and Consulting. I focus mainly on build to rent and multifamily, but all of our rental research, includes single family rentals as well. So we cover the for sale market, we cover the SFR market, BTR, multifamily, and we also cover building products as well.
Oh, building products like what?
Building products like
Like
anything that,
lumber?
yep, lumber, siding, windows, doors, flooring, you name it. If it's a product that goes into residential, for sale, single family, multifamily, our building products research team covers that.
Fantastic, which of course then immediately puts tariffs into your immediate future for discussion with me in a few minutes. So, but let me start with this other kind of higher level question that I'm really interested to hear or your thoughts about. So there's some very strong. I've been in this business for several hundred years, and there's some very strange things going on in the housing market. The term I like to use is it's just kind of locked up. Look, short supply, high demand, but a locked up market. So what's going on with single family housing in America today? What are the
Yeah,
factors
and
that are impacting it?
Absolutely. You mentioned locked up. We use the term the lock-in effect, where so many American homeowners who either purchased or refinanced their homes in the period of ultra low interest rates 2, 3, 4, 5 years ago, when you could get a 30-year fixed rate mortgage at 3%, 3.5%. So many of those folks are locked in, as you said, and so it doesn't make financial sense for them to move. The housing market thrives on constant moves. Households forming and buying entry-level homes, people moving up, people downsizing. But right now, across the housing spectrum, people are locked in. So there's not a lot of movement going on the for sale side. You see interest rates today, mortgage rates are in the 6 to 7% range, and that has significantly curtailed the movement, significantly curtailed people's interest in moving and purchasing homes. So it's had a bit of a double effect. One of the effects is that we've seen rental retention increase significantly. You can look at the apartment REITs, and they're seeing record retention or record low turnover. You look at the single family rental REITs, same thing. They're reporting record low turnover. When people are not moving out of rentals to purchase homes, they're likely to renew. They're likely to stay in those units. Given the challenge with affordability and just how expensive homeownership is as well, when you combine both the price of homes as well as the mortgage rates, that's another driving factor behind a relatively strong rental market. And now I say relatively because certainly the multifamily and the BTR side of things went through their own supply wave. And we saw generational supply hit the market in the past year, but we're starting to move past that. So there's some optimism on the rental side, buffered by the fact that homeownership is so unaffordable right now, and the fact that we're moving past supply. And demand has remained steady. In fact, Q1 demand, Q1 2025 demand, and we look at demand as the number of units that are being absorbed. One of the best first quarters we've seen in a long time for apartment demand, apartment absorption. Um, Now we do see some potential challenges from a housing demand overall if the economy continues to cool, if the job market continues to soften, as we've seen some indicators that it is, and if we see kind of the general slowdown in housing demand driven by the macroeconomy.
Yeah, it's really strange, isn't it? So if you look at this from a kind of classical economic perspective, classic economics, you've got a locked in population, so putting pressure on supply, right? So less supply. Now things happen to demand. So from that, in other words, demand is still there, but you would expect therefore prices to go up, which they are still doing, right? Homes are still going up in price. But on the flip side of that, you've got higher interest rates, which put pressure down on prices. So, like, it's really unusual. I've never seen anything like this. I've been in this business for a long time, and it's a really unusual effect. So, and we can talk about the dollar and confidence in the dollar as well, if that's something you're comfortable talking about. But is is the solution to the housing freeze, if you like, uh, lower interest rates? Is it really as simple as that?
I think that's a big component of it, certainly. And we've done a lot of research at John Burns Research and Consulting about what we call the magic number and what's the magic mortgage rate number that would really ease that lock-in effect. And we've identified it to be somewhere around 5.5%. Now we're 150 basis points above that in terms of mortgage rates today. So dropping mortgage rates, dropping interest rates would certainly have a huge beneficial impact for the housing market in general. But the other thing that I would say is home prices would recover, or recovering home prices, declining home prices would help that as well, would help unlock some of that. And we've started to see that. For the better part of a year or so, Florida and Texas have had supply challenges, both on the for sale and for rent side. And we've started to see heavy use of incentives on the home builders. as well as overall price cuts, and certainly price declines in the resale market, it's starting to grow beyond Florida and Texas as well. The mountain states, Colorado, Arizona, over into Tennessee, Nashville, we've started to see some price declines as well. There are a lot of indicators about a softening home market. Now, I don't foresee a 2008 type correction, or a 2006, 2007, 2008 type correction, but we are starting to see some cracks emerging in the both the home builder market as well as the resale market.
Yeah, that's really interesting. So is that because the reality of economics and having high mortgages is outpacing the lack of supply component of the equation? It's like people are looking, right? But like, why would, even with so short supply and such high demand, why is there softening of pricing? That's what I'm trying to get at. Like, what's happening?
Well, I would say that we're starting to see an increase in supply, actually. The home builders are showing more standing inventory than they've had for quite a while. Um, Resale supply is starting to increase, especially again in some of those markets, the Southeast, the Southwest, Texas, Colorado, Arizona. Really, the housing market can be seen as a bit of a tale of two markets. The Northeast, the Midwest, parts of the West Coast remain in very, very tight supply, very, very strong, or I should say, steady demand, but very, very tight supply. And so you continue to see price increases, far lower concessions and incentives in those markets. The same can be said on the rental market. You look at markets like Boston, New York, Chicago, Seattle. San Francisco actually is starting to see rents increase on a year-over-year basis. You look at places like Austin, Dallas, Denver, Nashville, Charlotte, rents are still down, and that's heavily supply driven. But to answer your question again, we are starting to see builder inventory pick up, supply pick up, resale supply pick up, and I think that's what's leading to the ever so slight softening in prices. Again, I don't expect we'll see major price declines, but we're certainly seeing stagnating pricing and softening pricing on the margins in certain markets.
Sorry, just to get back to this very interesting point you said. I was going to interrupt you when you said you've identified the sweet spot, the Goldilocks level of interest rates, and I was going to jump in and say, oh, let me guess. But I was going to say in the fives. It's got to have a five handle on it. You've concluded 5.5%. How do you come to that conclusion? What is that? Like, what's your research methodology to figure that out? How have you figured that out exactly?
Yeah, so we looked at a number of factors. We looked at what it looks like historically in terms of generating demand and generating activity. We also look at kind of the what I would consider to be the slight softening or melting of that lock-in effect already. And we know that not everyone can stay in their 3% mortgage. There are reasons that people need to move, for family reasons, for job reasons, for personal reasons, whatever that may be. And so not everyone is locked in, or perhaps there is there are certain reasons beyond financial reasons to move. And so we've looked at both kind of the historical trend, the cost of what a mortgage would look like, cost to income ratios and things like that. And that's how we kind of identify that magic number to say it's in the fives. You'd see some of that softening. And I could point you to some of our research as well. We've seen the percentage of mortgages with a three handle, percentage of mortgages with a four handle, with a five handle, with a six handle, with a seven handle, even in different markets in different states across the country. Over the past 3 years, since rates have gone up, you started to see a little bit of that thawing, a little bit of that softening of the lock-in effect. It's not in full force. We believe that when it gets to about 5.5%, that's when you'll see a more material shift and more activity on the buyer side.
Interesting. And then you've also got this demographic wave as well. I mean, it's something that's going to happen very quickly, but baby boomers who presumably are in many cases overhoused and may even have no mortgages, actually, or very low mortgages, as they come to market because maybe they need to sell not to move into another home, but into assisted living or some kind of senior housing situation. Is that something that's going to have any kind of significant impact? Is that something you've looked at?
It is, and I think it will have an impact. But as the moniker of demographics, the glacial science implies, I think it'll be a very slow impact. We've seen that the baby boom generation en masse, and I hate to paint with a broad brush, but for this purpose, I'll paint with a broad brush. They want to age in place. They want to age in their homes. To your point, many of them don't have mortgages at all, and so I think a lot of the baby boomers are staying in their homes longer than perhaps economists or demographers expected 5, 10, 20 years ago. And so that rapid turnover of baby boomers selling their homes to Generation X and millennials, I don't think it will be rapid. I don't think it will be immediate. I do think it will take place over time. Medical science is advancing, baby boomers are living longer, and technology is allowing baby boomers to age in place and to remain at home. Um, so again, I think it will happen, but I think it'll take place very, very slowly.
Yeah, it's an underlying trend, isn't it? It's not a leading trend, but it's something that will always be there, at least for the next, 10, 20 years or so. So what are you looking at? And I'd like to move to some macro topics. So to kick that off, what signals are you watching that could, I mean, you actually you said I don't think it's going to be dramatic, but you did compare it with the GFC, right? The global financial crisis, and you don't think it's going to be that bad. Okay, but even drawing a line between these two suggests that there is some potential for a significant correction. What are you watching in terms of macroeconomics that are the signals that will, potentially adjust your view of where the market is going in terms of pricing for housing?
Yeah, and I want to clarify, I want to be clear. I don't see us going anywhere near kind of the GFC level correction. But we have started to see some slowdown. We've seen some softening in the employment numbers. We've seen continuing jobless claims accelerate, even though new claims, initial jobless claims, have not grown rapidly. Those continuing claims are continuing to rise. There are a number of I'd say, quantitative factors that we're looking at, employment certainly being one of them. Um, as it relates to the rental market specifically, we've seen a significant pullback in immigration, certainly related to the current administration's immigration policy. And that's immigration that is related to student immigration, H-1B immigration, certainly southern border crossing immigration as well. So we know that immigrants tend to rent first when they come to the U.S. And they could rent high-end apartments, they could rent single-family rentals. Immigrants of all walks of life are often renters in different types. So the slowdown in immigration we think will certainly have an impact on the rental market. The employment slowdown will has the potential to have an impact on the for sale market, which is already slow, as we've discussed, and the rental market. We believe right now that where households are being formed, given the affordability challenges on the for sale market, given the relative affordability on the, excuse me, given the affordability challenges on the for sale market, given the relative affordability on the rental market, rent to income ratios are actually quite strong in a lot of markets because rents have not grown as quickly as wages over the past 2 or 3 years. As I mentioned earlier, we have this glut of supply that we're working through, especially in the Class A multifamily market. So concessions in multifamily across the Southeast are still pretty common. Rent to income ratios are actually in pretty healthy territory. So where we do see household formation, I would expect the lion's share of that household formation to be rentals. But again, looking at household formation, if that slows, looking at the employment market, if that continues to soften, that would give me pause, and that would be an indicator for more of an economic slowdown that would bleed into the housing market.
Let me just ask you a couple of stats. just to contextualize a couple of things that you've said. They're really interesting. First of all, we have talked about not as bad as the GFC. What does that mean actually? What, just define that in numbers. I mean, I have a number in my own mind about where values went, but yeah, give me actual numbers.
Yeah, and again, nationwide, I think we would see maybe a 1, 2, 3% decline in home values. I don't think it'll be major. Certain
And the
markets,
GFC was, I know the answer. So what was the GFC? It was like 20, 30%, was it, or further in some places. That was total devastation.
yes, yeah, certainly double digits, 20 to 30%. I don't disagree with that at all. And you're right, there were some markets, there were some submarkets that saw even more significant losses. So again, at the national level, I don't think we're going anywhere close to the GFC. Um, Low single digit price declines for this year. Um, but again, I think a lot of it, and perhaps even more so than the GFC, which really kind of took the nation by storm. Again, Vegas, Phoenix, there were markets that got hit harder, but for the most part, the nation was hit hard. Um, there are markets in the Northeast, in the Midwest, where we're not predicting any declines this year. Again, markets like Florida, Texas, Colorado, Arizona, to an extent, I think you'll see price declines come in even lower than the national average.
Yeah, so a 1 or 2% is de minimis, frankly, even on a national level, right? It's almost zero. And in a way, um, a stable housing market is one that is without dramatic increases or dramatic drops. So could one make the case that actually interest rates where they are now is the right level if if it is if we're seeing a stabilization of the market?
Yeah, I think you could make that case. I think when we look at kind of some of the leading indicators and looking at the home builders, um, looking at the resale market, I would say these are indicators of the broader economic um, situation. And when you see talk of price declines, talk of rising inventory, that tells me that interest rates are higher than they should be or higher than normal. But are they drastically higher than normal? Not necessarily. A number of economists that I follow say even if we go into a mild recession, and we don't have a recession forecast on our side quite yet, but I've seen some that do expect to see a recession this year, this calendar year. Um, Even in a recession, they don't necessarily believe that the 10-year treasury is going to fall much below 3, 3.5. And if you look at kind of historical spreads between treasuries and mortgage rates, that would still be certainly a high five, low six mortgage rate. And that could be where we stay. That could be kind of the equilibrium level of mortgage rates and interest rates. Again, I don't think we're going to see the Fed cut rates to zero. I don't think we're going to see the 10-year fall to 1 or 1.5 where it was for, a good bit of 2020, 2021, 2022. So I think we're elevated from that totally stable level or that totally neutral level, but I don't think we're necessarily super um, significantly above it.
Yeah, let's drill down on interest rates in a second. But I did have another question based. It's the minor one, based on a comment you made. You talked about strong rent income level for rentals. So what exactly is that? Precisely, again, put some numbers on this. That's a multiple of income, is it? Rent based as a multiple of gross income or after tax income. What is that?
Yeah, as a percentage of gross income. And so, yeah, so we see national rent to income levels are around 25%.
Okay.
Typically, in the rental industry, you would say anything 30% or above would be rent burdened or a high rent to income level. There are even some markets like Austin. Now, Austin has seen some of the largest rent cuts and rent declines over the past 2 years, while incomes have, not risen significantly, but they've continued to rise. Austin's rent to income level is around 19-20%. Again, that's at the market whole. That doesn't look at income quartiles and that doesn't look at specific property classes, but market as a whole. 19-20%, pretty healthy rent to income level by historical standards. You go all the way up to a market like New York, where their rent to income ratio is in the 40s. So certainly a more expensive market and a more expensive market compared to median income in a place like New York. But overall, again, the national average is about 25%.
Right. So 4x. So you would be looking at rent times four for income. That's basically what you're talking about. Yeah.
That's right.
That's interesting that Austin is at 5x and yet suffering from downward pressure on rents. I mean, yeah, go ahead. I mean, you can make a comment about that. I do like the national stuff. What's going on in Austin that's causing that? It's curious.
Yeah, Austin's a fascinating story. Austin has seen some of the most supply as a percentage of their existing stock,
Mm,
and it's come very quickly into the market.
mm,
Now, demand was high. Demand was high even before COVID. Demand was high before, rates went to zero, before everyone, started moving in as a result of the pandemic. Um, and so it seemed like every developer and then some came into the Austin market, specifically downtown, specifically North Austin, the 35 quarter, I-35 quarter heading up towards Pflugerville and Round Rock and Georgetown. But even, wrapping around the east side of Austin and the southeast side of Austin, just tons and tons of new supply. And that's really been the initial driver behind the rent softening, concessions 2, 3 months free in certain scenarios. But interestingly enough, the demand continues to be very robust in Austin. Austin is absorbing units at a very rapid pace.
mm.
Now, not quite fast enough to counteract all the supply that has come online. Their occupancy is still declining slightly. Their rents are still declining slightly, especially for new builds and properties in lease up. But the absorption and the job growth remains very, very strong. And so we've seen Austin move past peak supply. They will continue to deliver units this year, but going into 2026, going into 2027, if the demand holds up, and again, that's a big if. We talked about the job market, we talked about household formation, but if demand in Austin remains, you could see a pretty quick bounce back in rents, in occupancy, and certainly looking at 2026, 27, 28, Austin could be one of the better performing markets again, especially because rents have fallen so much. Those rent to income ratios are relatively low when you look across the country.
Chris, you guys look at a lot of data and you pass a lot of data to come up with these analytics. But what are you seeing? And this is something I'm not sure there's much data. If there is anything, it's mostly anecdotal, I would think. But there are certainly indicators. But the so to unlock the sorry, locked in, you called it, right? Locked in. Yeah. So to unlock the housing market, you've made the case for reducing interest rates, right? This is down to 5.5%. Yeah, somewhere in there, right? So it's 5.5%. There's an extraordinary pressure on the Fed, and they're looking at inflation and employment. These are their mission or their mandate is inflation, keep mandate inflation down and employment up. Um, but they're coming under tremendous pressure from the White House, unusually so. Again, not something we've really ever seen before. And this is affecting the way that investors are looking at the US economy, at American exceptionalism, at the state of our institutions, etc. So, uh, how do you guys analyze those factors when you I don't know. Do you predict where interest rates, at least when you start making your projections? And it just creates this incredible fog of unclarity, doesn't it?
It does. It does. And to your point about the qualitative side of the economy, of the housing industry right now, I think that's a bit of the lock-in effect as well. There's a financial component of the lock-in effect, but also an uncertainty effect. If you don't know, excuse me, how stable your job is, you might not be looking to buy a new house in the coming months, or even rent a new apartment. You might be more inclined to renew and stay. I think the uncertainty that is pervasive, if you're unsure of what inflation is going to look like, tariffs are on, tariffs are off, tariffs are on for here, off for there. Um, there is, and I know it's cliche, I know it's used quite a lot, but there is incredible amounts of uncertainty right now. And I think that's kind of keeping people on the sidelines and keeping people cautious as well. I don't have a direct line to Jerome Powell. At times, I wish I did. I think it'd be a fascinating conversation. Um, but you're right. We haven't seen this type of public rhetorical strain put on the Federal Reserve in my memory. And I think that's leading to Jerome Powell being very, very cautious. Even this week, with the prospect that they may announce a shadow Fed chair this year, with Powell's term not up until next May, that just leads, in my mind, and from watching Powell's testimonies through the years, he wants to be absolutely certain of every single data point before he makes a decision. And I would say that speaks for the entire FOMC today. Um, so when I look at what's going on, I think they'll stand firm. You look at his testimony to Congress this week, and he said, we're in a very good place to wait and see. Um, I know a lot of people, both in the housing industry, the White House, the vast areas of the economy would love to see an interest rate cut, but I think he has been very clear and transparent, that he's going to wait and see. And I want to touch on one other point you made about perhaps international capital, or the perception of the American economy from an international perspective.
Right.
It was 6 or 8 short months ago, when the acronym TINA, there is no alternative to investing in the American economy, investing in American capital markets. There is no alternative in American housing, in many American institutions. That was the rally cry. You heard that from economists all over the place. Um, how quickly that has changed. And going to some of our apartment industry conferences, I hear from big CEOs, big capital providers. There's a hesitancy for foreign direct investment in the U.S. And I think that was accelerated on April 2nd, April 3rd. But I think that continues. And what impact that has on U.S. Treasuries, what impact that has on our economy, I think is yet to be fully seen. But again, from last October, November, of there is no alternative, it's the strongest market, we're going to continue to invest there, to wait a minute, I don't yet know what that alternative is. I haven't heard people say, oh, we're not investing in the US, but we're going to invest over here. But I think there's just this general pause, general caution, that's taking over the globe at this point.
It's interesting, Chris. This idea I've been ruminating over since I went up to. I'm not in LA, but I went to LA on Sunday and I came back on Wednesday. And in the course of that 3 days that I was there, America bombed Iran and peace and love broke out. And it could have gone either way at the end of it. But in the course of a super short period of time, a massive geopolitical event started and stopped. And it just struck me that we are becoming, it's almost as though the stock market did naff all, right? It's like nothing happened. It's almost as though we're becoming shock immune, really, at the moment. And that worries me. We're immune to these batterings, but, especially from the perspective of overseas looking in. And they're such important driver of the US economy, one way or another, particularly in terms of pressure on interest rates and bonds. Uh, it just makes me wonder if we're just not living in a very brittle, not fragile. I think if it was brittle times where something could just pop the whole system. I mean, it's a pretty gloomy outlook, but what do you think? I mean, you talk quite optimistically, but deep down, what do you think is going on here?
Yeah, and I don't want to veer into a lane of which I don't know, and geopolitics is certainly one of them. But I don't disagree with your sentiment about the brittleness of the American economy, the American housing market, American society to an extent. Um, my optimism, I think, comes in the form of continued innovation. We see continued tech innovation. We continue to see growth in the AI market. We continue to see some stability in the stock market, as you mentioned. Um,
Mm.
are we immune to so much different sensory activity, economic sensory activity, geopolitical sensory activity, societal sensory activity? Again, I wouldn't disagree with that either. I think we have entered a stage of immense activity. Um, do I think one event could set things off? I don't know. That again, that is kind of veering outside of my.
What about the deregulations that are being passed right now? So it's kind of today's news. Banking regs that were set in place after 2008 with the idea of avoiding, I think it's the capital levels, isn't it? It's the equity that they hold, to avoid another 2008 from happening, being rolled back. At a time of incredible fragility. Is that prudent? Where could that lead, do you think?
Yeah, and I haven't seen specifically what was rolled out or discussed today. But anytime you roll back certain regulations that were put in place to protect an industry that was hit so hard in the great financial crisis, and that was only 17 years ago, 17 to 20 years ago. So it was not so far in ancient history that we can't all
Some
remember
of
it.
us still remember it like it was yesterday.
I completely agree with you. I completely agree with you. That does give me pause. That does give me pause. And you mentioned, I'm generally optimistic. I do feel generally optimistic that the slowdown we're experiencing, or perhaps the slowdown that we're entering, is not going to be massive. Um, but with each passing change, that could grow. The risk and the opportunity for downside risk could grow.
All right, so let's switch to another topic that you've been talking about recently, and that is immigration and the impact on the home building and multifamily industry of deportations, I suppose, but also of immigration and all these raids that are going on, etc. So, can you? I mean, is that look? It's intuitive when you think as look. If you're in the industry, you know that most of the people on a job site have strange accents, even stranger than mine, basically, right? They're born overseas and they come to America. So you know intuitively that this is a very important component of the building industry. But can you actually quantify in any way the impact of immigration on the industry? It's right rather than just it's going to have a bad impact. Well, what exactly? Is anyone talking about actually quantifying that?
Yeah, absolutely. And I want to first and foremost say our industry relies so heavily. Our industry would cease to exist without immigrant labor, without a doubt. And so when you say, folks with strange accents, our industry, the lifeblood of the construction industry, without a doubt, is immigrant labor. And you're right. And it's labor in a number of different trades. Um, what can we say quantitatively? I don't have the numbers right in front of me, but our demographics team has done some excellent research to say at what percentage of the employment base for certain trades are immigrant labor. And so you see things like drywall, roofers, people
Mhm.
who work in flooring, painters, high percentages of those trades are immigrants, and somewhere in the 30 to 50% range. Those numbers increase even more so in states like California, Arizona, Texas, Florida.
Mhm.
And so again, where do we see the most home construction, multifamily and single family? Arizona, Texas, Florida. So a shift in the immigration policy will have has started to have a meaningful impact on construction labor. Now, can I quantify yet the number of construction laborers that have been deported? I can't. I have not yet seen that data. But anecdotally, certainly over the past 2 to 3 to 4 months, we've heard the discussion in the industry. It's harder and harder to find crews. Fewer crews are showing up. Crews are showing up at a more sporadic pace. Um, that type of anecdote, that type of qualitative story is definitely out there, and that will, without a doubt, have an impact. Will it have an impact on the number of units started? I think it will. Will it have an even greater impact on the construction timeline and therefore the cost to construct for many apartment developers, for single family home builders? Absolutely, absolutely. So there are excuse me, of ripple down effects that we're starting to see now. The quantitative data is not quite there that I have seen, but the qualitative messaging is absolutely there.
Interesting, isn't it? I mean, on a slightly different level, you've also got the skilled trades aging out. I mean, it's really incredible to see that. I mean, I see that locally. I started as I did I mention it to someone today. I started pulling wires for an electrician when I was first here. That's 45 years ago. He's still working. Unbelievable. The guy's still working. I don't know. But what happens when he goes? I mean, there's no one with these kinds of skills. And all the other skills, you're skilled, not laborers, but you skilled trades. They're aging out. It's really. Do you see that? Is that also impactful? I know it's not directly relevant today. It's one of those slow burn things, isn't it? But
Absolutely no, and again, I would point to our demographics research that has done some incredible work behind this. But the average age of plumbers and electricians and the skilled trades that you mentioned is steadily going up. It's climbing with each passing year, and akin to that demographic glacial science, that glacial pace that things move. Um, yeah, will the skilled trades disappear overnight? No, but you make a very good point. We are not replacing on a 1-for-1 ratio those skilled tradesmen and tradeswomen who are retiring. And I think that does become an issue down the road for us.
yeah, and it compounds any kind of immigration restrictions as well. Let's talk about tariffs as well. So you mentioned that you actually been research, so you research inputs. Fascinating. All right, so what's been the impact of tariffs so far, and where do you think that whole on-off story is headed?
Yeah, and our building products research team has done some really good work here. The tricky thing with the tariffs, I think, is that again, they're on one day, they're off the next day. I just saw today the July 9th trade deadline might be extended again, and who really knows kind of when the tariffs will start or what tariffs will start. Um, with that being said, when the tariffs were rolled out, our building products team did some really good analysis, and they determined that the impact to construction costs, to materials costs, I should say, are about 6 to 8%, would be about 6 to 8%.
Okay.
Um, that would have an impact of about 2 to 3% on the overall construction cost of a home, of an apartment, etc. So not immaterial, but not massive either. Uh, I've heard from a number of developers and a number of home builders that the immediate impact of the tariffs might not be massive because many of the subcontractors who in multifamily were building, had 1 million units under construction a year ago, now have 500 to 600,000 units under construction. So you can do the math there. There's more subcontractors looking for work today. So they might get a little bit more competitive, excuse me. They might sharpen their pencils just a bit and absorb some of that cost. So developers are not overly concerned quite yet. I think the larger concern is if the tariffs remain a year, 2 years, multiple building cycles, then then you'd start to see a greater impact on the builders and the developers. And then one other thing I'd say here, a lot of the tariff analysis, a lot of the discussion was around lumber and the tariffs on Canada. Um, the impact for multifamily, specifically urban high-rise multifamily that has much more reliance on steel and aluminum and imports from China and other areas, um, the impact from tariffs would certainly be higher there. And so the hit to a bottom line has the likelihood of being more impactful in some of those high-rise multifamily projects.
Chris, we've been talking for quite a while already. Just having a look at that. Oh my goodness. I don't want to burn up too much more of your time. Let me ask you one final question before I ask you my three final questions. It's like Columbo. You remember that show? Yeah, he's always, as he's leaving, he always turned around. Oh, just
Yep.
one more question.
One more, one
Right,
more.
right before he, solved the case. He knew exactly what was going on. Um, right. So multifamily, you've talked about multifamily being one of the more stable sectors of the economy, despite stress, right? I mean, we're looking at CMBS delinquencies growing, etc. So what underpins your confidence in multifamily and where do you think there are any weak spots?
Yeah, I'll answer your question. Perhaps we start with the weak spots and move towards the confidence and the strength. The weak spots are definitely in some of those markets that have seen the most pressure, the most supply pressure, um, the greatest number of what I would say um, quick entrance to the multifamily market in 2020, 2021, 2022. Perhaps folks who didn't have a lot of experience came in a very cheap money environment, said, look, I can double my money. I get 2x equity multiple. We'll be out in 3 years. This is the greatest thing since sliced bread. Underwriting very low cap rates, underwriting no increase in interest rates, financing it with floating rate debt, and March of 2022 happens through 2023. We see Fed funds go from zero to somewhere in the fives, 5.5, 5.75. And overnight, those deals are strained. Now, they didn't go into foreclosure overnight. They had 3-year loans. They had a couple of extensions on top of that. I think many of those projects are starting to their loans are starting to mature. Now, again, I don't think it's going to be widespread distress, but where there is distress, I think it's in that kind of older vintage, challenged market, a market like Austin or DFW or Nashville, where there's already a lot of supply. Folk apartments are offering significant concessions on new properties, so the rent has come down, and essentially the entire pro forma from 3.5, 4 years ago is up in smoke. Um, that's where I see the most challenge. Um, on the flip side, what gives me optimism? What gives me confidence in multifamily in general? Well, the first is that we continue to see kind of a stabilization in occupancy. Again, you could look at the public REITs, you could look at a number of the private data providers. It seems like we've found a floor in occupancy. Um, we have really, really strong growth, or I should say, really, really steady growth in markets like the Northeast, Midwest, parts of California, parts of Seattle and Washington, rents back in the 2 to 4% annual rent growth area. Um, at the same time, you see, as I mentioned with Austin, you see, excuse me, pretty good absorption across the southeast. They just have to fill up what's been built, and they have to fill up what's in lease up. And again, I'll reiterate a point I made earlier that the lion's share of household formation that is taking place is going towards rental because of the affordability challenges in the for sale market and because of that kind of uneasiness. You buy a home and you're locked in for 30 years. If you lose your job, you face, some significant challenges. You rent an apartment, you lose your job, perhaps you have to move back in with family, perhaps you have to double up. Even if you have to get out of your lease early, you're not under the financial burden that if you were to just purchase a home and commit to a 30-year mortgage. So um, I do see a little bit more tailwind and a little bit more stability. And again, we're seeing in the data that stabilization in the rental market. So I don't expect to see rents growing like crazy. There are some people in the industry that will say, hey, look, there's no supply. rents are going to be, double digits in 2027, 2028. There may be tiny pockets of that, but I do not see that as the larger trend. But I do see steadiness, steady growth as the reason for optimism. The fundamentals around apartments are strong, and given where the for sale market is, I think that's an added tailwind for the rental market.
Chris, what a pleasure talking to you. I'm so glad that we met there on LinkedIn and migrated to a podcast. Thanks. I really appreciate it. All right, so let's move to I have these, I think they're called rapid fire questions. I hear people talking about something else. Anyway, three final sign-off questions. So the first one, what are the two or three, this is to help people, listeners and viewers figure out what they can do as well to mimic you to get an idea of what's going on in the market. So what are the two or three market signals that you are personally watching that give you early warning of any shifts in the industry?
Yeah, I'm going to go heavy on the demand side, job growth and household formation. Those are really the bedrock of housing demand. And as we've talked about, there's elevated supply on the resale and for sale side. We've moved past elevated supply, but there's still decently heady supply in a lot of markets on the rental side. So job growth, which leads to household formation, which leads to housing demand. Those are the two that I watch closely.
Right. My second question, I've had a hard time actually constructing this question properly because it's difficult to put it in the petri dish I would like it to be. But the idea is this. If you suddenly came into $1 million after tax $1 million today, what would you do with that today?
That's a great question, and we're not in the business of investment advice, but if it
I
were
know, that's why I stumble over this question. I used to say, what would you advise somebody? Now I'm asking, what would you do?
what would I do if it were me personally? I would put it in rental. I would invest in rental, and I would split it out. I would kind of barbell it between strong Midwestern markets. We've seen really strong growth in places like Indianapolis, Columbus, Cincinnati,
Mm,
Omaha, Nebraska, even. Certainly Chicago has been one of the better markets as well, but the Midwest seems to be performing well. And then I'd split it in the Sun Belt. As much as we talked about the challenges in Austin,
mm,
there is opportunity in Austin, especially because the absorption seems to be so strong. I like the Austin market. I like the Carolinas. Charlotte and Raleigh have shown really, really strong opportunities, and certainly it's my main focus in my day job. But I like the multifamily market. I like the build to rent market as well. I like the rental market, professionally managed, institutional grade multifamily and BTR right now.
Okay, so and I wasn't gonna, I was gonna, I always have to resist the temptation to say, as I asked that question, so I'm glad you've answered it. Before I said, you wouldn't hold it in cash for the time being, would you?
I wouldn't. I wouldn't. I think, and you're starting to hear this in the industry, certainly in the multifamily industry, where you can purchase. I think it would be a good buying opportunity. Again, we're not in the business of investment advice. That's not what we do. But with the clients that we speak with, there is dry powder. There is capital looking to deploy in multifamily, in SFR, in the build to rent space as well.
Last question. So, what political or market developments? I know you're not a geopoliticist, but what political or market developments do you track that might cause you to rethink your assumptions about where the market is going?
That's a good question. I pause here. I would say really the the treasury market is what I'm focused on, and the treasury market can be influenced from a geopolitical perspective, can be influenced from certainly a monetary perspective, and can be influenced from a macroeconomic perspective. And so I think the treasury market still does a very good job of transparently displaying the strength of America, the confidence in America. You've even seen treasury yields drift a bit higher when there seems to be some global confusion or perhaps a lack of confidence a waning of confidence, I might say. So yeah, the treasury markets are something I focus very closely on.
Chris Nebenzahl, housing economist, right? At John Burns Research and Consulting JBRC. Yes,
Yes.
JBREC. Thank you so very much for joining us. It's been a real pleasure having you on.
Thank you, Adam. I really enjoyed it.
All right, that was Chris Nebenzahl, housing economist, John Burns Research and Consulting. Chris, thanks so much for joining me. It's a real pleasure to have the opportunity to talk to you today about these interesting events, right? The world is spinning at an incredibly fast rate at the moment. Sometimes it does feel like one might like to step off, but it's also really interesting to hear insights and I would characterize your perspective as cautious optimism. So it's nice to hear that perspective, and I really appreciate you spending the time with me today. Thank you. And thank you to dear viewers and listeners to today's episode. If you would like to read a written summary of our conversation today, an abbreviated written summary, but with all the highlights in easy to read format, easy to read and scan format, subscribe to my newsletter. It's there at gowercrowd.com, and you can always unsubscribe, of course. It goes out as often as I record these episodes, and occasionally even more often. But all there at gowercrowd.com. Oh, and if you've not connected with me on LinkedIn yet, please do so. Just look me up, Adam Gower, or look up Gower Crowd. I should pop up fairly quickly. That's how I met Chris, actually, looking at some of his commentary. And we connected there. It's a great way to make connections and to make new friends in a business sense, right? It's not face chat or anything like that. It's a business environment, business casual, I like to call it. Okay, so go ahead and connect with me and with Chris over there on LinkedIn. Okay, that is all I have for this episode. Thanks so much for joining me. And until next time, this is Adam Gower signing off.